So we're gonna be diving into what exactly is margin in day trading, the pros and cons of using a margin account, and of course, how to properly use it to grow your trading account. Before we start, please remember to drop a like to sign up for a free subscription of bad jokes. Seriously though, be careful what you wish for. So here's the difference between what it means to day trade with a margin account versus cash account. Let's say we have a $5,000 small cash account, which is what most conventional investment accounts are to day trade. Let's say I want to buy Tesla stock right now at $340. Normally, if I'm buying with a cash account of $5,000, I could only buy 14 shares of Tesla stock. And if I sell my shares at $360, I make $20 a share. On 14 shares, that's $280 worth of profit from a cash $5,000 account. That's not bad, right? Now, what if I'm trading the same $5,000 capital with a margin account? Trading on a margin account allows you to borrow funds from your broker, hence increasing your buying power in order to purchase more shares than if you were just using your own $5,000 in capital. So instead of just my cash buying power, I could use up to $20,000 of buying power if I use margin. So in this example, if I intend to buy Tesla stock here at $340 and sell it for a quick bounce, I could buy double the amount of shares of Tesla than if I were using a cash account, since my broker allows me 4-to-1 leverage. So if I do the same thing and sell my Tesla stock for a bounce of 20 points, then I made $20 a share. On 30 shares, that's $600 in return, only using my own $5,000 of capital. Again, this is just an example. You definitely don't want to use all of your $20,000 of buying power. And this is the biggest pro of trading on a margin account. By using this leverage properly, margin accounts allow you to amplify your potential returns. But at the same time, your potential risk is definitely going to be higher as well, which is very important, and we're going to be going over that in just a little bit. When you're using margin, you're borrowing money from your broker to finance part of your trade. Most brokers will give you 3-to-1, 4-to-1, or sometimes even 6-to-1 worth of buying power. So with the same $5,000 capital, I could get up to $15,000, $20,000, or even $30,000 worth of buying power. Now that's the leverage when you're trading on margin intraday. But when you're holding positions overnight, your buying power drops to 2-to-1. So the maximum amount in this example would be $10,000 worth of buying power overnight. The leveraged buying power is definitely the first pro of trading on margin. Now, the second pro of trading on a margin account is the trade settlement periods. If you're using a cash account to day trade, the amount of capital you put into your trade positions will take 2 days before it comes back into your trading account. So in our example earlier on the Tesla trade, if I bought 14 shares of Tesla and made $280 of profit, I would have to wait 2 trading days for that cash $5,040 to return to my account in order to use it to trade again. $4,760 was my original capital I used to buy 14 shares of Tesla, and $280 was my profit from the trade. So in other words, after that Tesla trade is closed out, I would only have $240 left in my cash account for the next 2 days. I essentially can't trade anymore until that cash settles. It's very important that you actually wait 2 days. Trust me, you don't want to experience any cash settlement violations and risk your broker locking your account for 90 days. This is the same as violating the PDT rule. But on the other hand, with a margin account, you do not have to wait for the cash to settle in for 2 days before reusing the capital again. And this, my friends, is extremely beneficial, especially if you want to trade full-time as a day trader. There's always different opportunities in the stock market every single day. I don't want to have to wait 2 days to day trade again. So in our example earlier, once I closed out of my Tesla long position, while the profits of $600 will not come in until the next trading day, I could reuse my original $5,000 of capital and then the same $20,000 of buying power in the same day. Now, the third pro of using a margin account. I know you're going like,
hold up there, humble trader. This more? This is way too much.
Yeah, I kept the best for last. And this is none other than the ability to short sell with a margin account. Even if you don't need that extra leverage in buying power, or you don't care about the cash settlement period because you're already a baller, having the ability to short sell just opens so much more opportunities to profit in the stock market, whether the market is going to the moon or crashing to the ground. A margin account allows you to short sell and profit from the falling stock prices. When you're shorting, you're essentially borrowing shares of a stock from your broker to sell, and then you buy them back later on, hopefully at a much lower price, and you profit from the difference. And you cannot short sell with a cash account. And that, my friends, is what it means to day trade with a margin account. I see you're getting interested. But you know me, I'm not going to give you all the rainbows and sunshines and Lambos without explaining to you the potential downside of trading with margin accounts. And why am I saying this? Trading on margin comes with higher risks than using cash accounts. Since you're not only trading with your own money, you're also trading with your broker's capital. If you start gambling with your entire buying power, chasing the high of the day breakouts and following chatroom alerts, not only do you risk your original $5,000 of capital, you could also owe your broker a lot of money. Okay, this is serious talk here, and I'm kind of like sweating because shit just got really hot. Whether you are a new trader or not, the risk of trading on margin is extremely important to understand. If you're using a margin account, you must be aware of the margin maintenance. Margin maintenance is the amount of capital you need in order to keep all your trading positions open. For example, if a trader borrowed from the broker's money to buy 30 shares of Tesla at $340 like our example earlier, he or she would need to borrow an additional $5,200 on top of their original $5,000 of capital. So the total value of this position is now $10,200. And the margin maintenance in this case would be around 50%, because around half of the capital used here belongs to the trader. And if this broker has a margin maintenance of 30%, this stock position is perfectly fine right now. This trader is good. We're good. Now, God forbid, on that same day, Elon Musk is bored out of his mind in the office, or he decides to smoke a little bit something, and he decides to tweet on his phone, Tesla stock is too high right now, IMO. And after he sends out that tweet, Tesla stock drops to $240. That means the value of this trader's long position in Tesla stock is now only worth $7,200. But remember, this trader borrowed $5,200 earlier from the broker, since he used margin to purchase this Tesla stock position. This is where the trader will be trading in very dangerous waters. Get it? Because if you take the valuation of the Tesla long position, which is now down to $7,200, minus the original amount he loaned from the broker, the $5,200, the amount that actually belongs to the trader is now only $2,000. Now that little amount remaining is now only worth 27.77% of margin maintenance. And remember what we talked about earlier, the margin maintenance is 30% for this account. And since the current valuation in the Tesla stock is down from $10,200 to $7,200, the trader must keep at least $2,160 in the trading account in order to keep it above 30%. Otherwise, he runs the risk of his broker liquidating his entire account and close out his Tesla position for him. The moment your margin maintenance drops very close to or below the minimum, this is when you'll get a very important phone call. No, it's not the guy or the girl calling you to tell you how much they miss you. I mean, I wouldn't know what that's like. No, this is even worse. The Mike Bagholder contacting me again. This is what we call a margin call. A margin call is not an actual phone call nowadays. Maybe it used to be, but even the brokers nowadays are too lazy to pick up the phone and dial. No, it's an email or a text alert sent from your broker straight to your cell phone, demanding that you fund additional capital so your position keeps above the 30% maintenance. To respond to the margin call, in this case, the trader in our example could, number one, either fund at least additional $160 to an account to stay above 30% margin maintenance. Option number two, sell part of the stock position for a loss. But this equity that's released will reduce the amount of money that he is borrowing from the broker. If the trader does not respond to option one or two quickly, then the broker may liquidate the entire position for him without further notifications. Margin calls and liquidation ensures that the broker will get the original $5,200 of loan back. I mean, they gotta protect their ass, right? So they want to make sure their own money is safe, and maybe some of the traders too. Maybe, just maybe. So if the trader's Tesla long position, in our example, gets liquidated at $240, that means the trader would take a loss of $100 a share, thanks to Elon Musk's tweets. On 30 shares, that's a realized $3,000 loss. Basically, this is a 60% haircut on that original $5,000 of margin account. Just like I mentioned earlier, while using margin gives you 4-to-1 or greater leverage buying power, it also increases your risk. And that's why I have some trading tips for you if you decide to use a margin account. Number one, do not over leverage. Be smart. Just because you have that much buying power doesn't mean you need to use it. For example, if I have $50,000 in my trading account right now, that means I have up to $200,000 worth of buying power. Just because I have the buying power doesn't mean I'm going to use it. And especially if you're new to trading and your capital in a margin account is only $5,000, then you should only trade with that $5,000. So for that example, you should only buy up to 14 shares of Tesla. You could definitely keep the margin account so you get the ability to short sell and have the funds settle in your account within the same day. But please be smart. Just because you could use a buying power doesn't mean you should. Number two, and it's very important, follow your stops. The trader in our example earlier, his name was Mike Bagholder. He didn't follow his stop. A proper trading plan should include an entry, profit target, and most importantly, a stop. So you can prevent one losing position from blowing up your entire account like we talked about. Now, back to the original question from the beginning, should you day trade with a margin account? Well, I'll tell you this right now. Margin accounts are extremely beneficial for professional full-time day traders who use them to maximize profits both on the long side and the short side. When used correctly and accordingly, you can leverage your buying power and take advantage of the market volatility. But when used incorrectly, or if the trader disregard risk management, he or she could lose the entire trading account due to a margin call. Again, your trading account type, whether it's cash or margin, it's just a tool of doing business in day trading. By itself, it's not going to determine your success nor failure. There's a lot of misconceptions online about margin. It carries a bad rep because a lot of people say it's gambling or it'll be the reason you blow up. All my accounts I use to day trade are margin accounts, and it's the same way for most full-time day traders I know. Let me reassure you, margin by itself, it's not the reason traders fail or blow up. It's the trader's own lack of risk management or the lack of discipline. And for many people, it's the fact that they rely on chatroom alerts that's doing the damage. And truth be told, a reckless trader can blow up either margin or cash accounts. So this is definitely not limited to margin, my friends. Let me know whether you're day trading with a cash or margin account in the comment section below. Thank you guys so much for watching as always. I'm the Humble Trader, and I'll see you guys next week. Hey guys, thanks for watching. I hope you enjoyed the video and the bad jokes. If you want to see more day trading content, make sure to subscribe and follow me on Twitter and Instagram for more. If you'd like to trade with me daily and get my free weekend watch list and trading journal, make sure to check out the links below for more resources. Stay green, stay positive, and I'll see you guys next time.